All right. What are we doing? Okay, here we at. We are going to be reading this right here. The computer's tripping. How do banks create money, and why can other firms not do the same? An explanation for the coexistence of lending and deposit taking. It is interesting. Wait a minute, I just had it in a different. Hold on. Let me see. I'm supposed to have it here. Full download, view PDF. Okay, let's do it. There you go. This is it right here. It's the International Review of Financial Analysis. And this is by Richard A. Werner. Center for Banking, Finance, and Sustainable Development, Southampton Business School, University of Southampton, United Kingdom. Abstract. Let's read the abstract. Thanks to the recent banking crisis, interest has grown in banks and how they operate. In the past, the empirical and institutional market microstructure of the operation of banking had not been a primary focus for investigations by researchers, which is why they're not well covered in the literature. One neglected detail is the bank's function as the creators and allocators of about 97% of the money supply. And he's citing this right here, which is another paper of his, two more papers, which has recently attracted attention, this is another paper right here. It is the purpose of this paper to investigate precisely how banks create money and why or whether companies cannot do the same. Since the implementation of banking operations takes place within a corporate accounting framework, this paper is based, right here, see? This paper is based upon a comparative accounting analysis perspective by breaking the accounting treatment of lending into two steps. The difference in the accounting operation by banking and non-banking corporations can be isolated. As a result, it can be established precisely why banks are different and what it is that makes them different. They are exempted from the client money rules and thus, unlike other firms, do not have a segregate client money. They don't have to segregate client money. This enables banks to classify their accounts payable liabilities arising from bank loan contracts as a different type of liability called customer deposits. Let me read that again. We need to understand what this says just now. Let me read this. So basically, you see, let's read it from right here. Okay, let's read this. It says, okay, they are exempted from the client money rules. They are exempted from the client money rules and thus, unlike other firms, do not have to segregate their client money. This enables banks to classify their accounts payable liabilities arising from bank loan contracts as a different type of liability called customer deposits. So basically, this is very interesting. Anyway, we'll get to that and you can research that on your own, but we'll continue reading. The findings is important for many reasons, including for modeling the banking sector accurately in economic models, bank regulations, and also for monetary reform proposals that aim at taking away the privilege of money creations from banks. The paper thus adds to the growing literature on the institutional details and market microstructure of our financial and monetary system, and in particular offers a new contribution to the literature on what makes banks different from an accounting and regulatory perspective. Solving the puzzle is why banks combine lending and deposit taking operations under one roof. See, basically, if you look at it, right, the banknotes, these all have these serial numbers. So obviously, although they all look identical, what makes them different are these serial numbers, right? So if you are going to exchange your time and energy for one of those, and now one of those is rightfully yours, you have now claimed it, you're now owner of a note, you have a way to identify that note that belongs to you, which is through that serial number. Now when you make a deposit, what they say, when you hand that over to the bank, what is happening, you're lending it to the bank. So the bank can have it and then not have to account for it in the way that's so specific that it actually would write down and record the serial number of the note that you or we provide to them, lend them. So they take that note with that serial number and they just hand it out to somebody else. So what they're doing is we are lending them these notes and they're borrowing it, but they, instead of putting it on the accounting as accounts payable back to us, it just goes in as a bank deposit. That's what he's saying. Let's go back. Introduction. Number 1. Thanks to the recent banking crisis, interest has grown in the details of how banking operate. In recent decades, the empirical and institutional microstructure of how banks operate had not been a primary focus on the attentions by investigators. This lack of interest may partly be due to the predominance of the hypothetical deductive research methodology of economics. Wow. Which begins by posing axioms and assumptions. Such a theoretical and hypothetical framework has also been the basis for bank regulations. As is well known to historians, reality may be less logical and rational than the designers of theoretical constructs may envisage. This is known in other areas of finance, where market and investor behavior often does not conform to the precepts of theoretically posed rational agents. By construct, an inductive approach begins by establishing the empirical facts. Okay, so we have to establish facts that are known as empirical. Over the past century and a half, 3 competing theories of banking have been influential. 3 theories, 3 of them. The financial intermediation, that's 1. The fractional reserve, that's 2. And the credit creation theory, 3. Financial intermediary, fractional reserve, and credit creation theories of banking. Most current models, theories, and textbooks in finance and economics assert the validity of the financial intermediation theory. According to it, banks do not have the ability to create money, neither individually, as the credit creation theory argues, nor collectively, as the fractional reserve theory maintains. Recently, 2 events have upset the status quo in this debate. The Bank of England has come forward clearly in support of the credit creation theory. And he cites this paper right here, Bank of England, and this. Secondly, the first empirical tests of the 3 theories have been conducted. And here he cites that too. We gotta read all of that, man. That's juicy stuff. These tests showed that the financial intermediation and fractional reserve theories are not supported by the evidence. Banks do not gather deposits and then lend these out, as the financial intermediation theory assumes, nor do they draw down their deposits at the central bank in order to lend, as the fractional reserve theory of banking maintains. The empirical facts are only consistent with the credit creation theory of banking. According to this theory, banks can individually create credit and money out of nothing, and they do this when they extend credit. When a loan is granted by a bank, it purchases the loan contract. Legally considered a promissory note issued by the borrower, which is reflected by an increase in its assets by the amount of the loan. The borrower receives the money when the bank credits the borrower's account at the bank with the amount of the loan. The balance sheet lengthens. Through the process of credit creation, 97% of the money supply is created in the UK today. This is also cited in Werner 2005, and similar proportions apply to most industrialized economies. Not surprisingly, the use to which bank credit is put to determine its effect, namely whether bank credit is extended for productive, consumptive, or speculative purposes. The quantitative theory of credit. See, there you go. One reason for the neglect of the institutional and operational details of banks in the research literature in the past decades is likely the fact that no law, statute, or bank regulation explicitly grants banks the right, usually considered a sovereign prerogative, to create and allocate the money supply. As a result, many economists, many finance researchers, lawyers, accountants, even bankers, let alone the general public, have not been aware of the role of banks as creators and allocators of the money supply. The establishment of these facts motivates a number of new research questions, many of which did not arise within the two alternative theories of banking. In this paper, the question is considered of what exactly it is that enables banks to individually create credit and money out of nothing, and why or whether other financial firms and intermediaries or ordinary corporations not active in the financial sector cannot do likewise. Is what enables banks to create money a feature unique to banks, or is Miskie's 1986 publishing claim more relevant that everyone can issue money? Being able to create money is a desirable ability, and if it was possible for other agents to do so, they would likely also engage in this activity. Are non-bank financial institutions, including so-called shadow banks, engaged in money creation? It's a good question. With financial deregulation and the development of hybrid financial instruments, the demarcation between banks and non-banks often is said to be elusive. Is it possible to pinpoint the difference? Good question, is it? Let's see. Furthermore, there are a number of fundamental questions concerning banks that remain unanswered in the literature. What are the defining characteristics of a bank? Asks Kashyap, Rajan, and Stein in the 2002 paper. Specifically, it remains a conundrum to economists why banks combine what are effectively very different operations, namely deposit taking and granting of loans. and why securities or capital markets cannot substitute these functions, despite in theory being capable of doing so separately. Quote, commercial banks are institutions that engage in two distinct types of activities, one of each side of the balance sheet. One on each side of the balance sheet. Deposit taking and lending. A great deal of theoretical and empirical analysis has devoted to understanding the circumstances under which each of these two activities might require the services of an intermediary, as opposed to being implemented in arm's length securities markets. While much has been learned from this work, with few expectations, it has not addressed a fundamental question. Why is it important that one institution carry out both functions under the same roof? It's a good question. Very, very good question. Reasonable. They also argue that it is of utmost importance to answer this question. Okay, the question of whether or not there is a real synergy between deposit taking and lending has far-reaching implications. They cite the question of monetary reform as one of the reasons why the question needs to be answered. Their own answer is based on the provision of loan commitments by banks, a particular institutional feature that does not apply to all banks and does not usually dominate bank lending. It is hence difficult to argue that the question they raise has been answered fully. This is especially true since the authors are adherent of the financial intermediation theory of banking, which claims, erroneously, that banks gather deposits and then lend these deposits out. It is the purpose of this article to offer new answers, and these questions, which are in line with the empirical record, Joseph Schumpeter argued that banking is primarily accounting, and that banks are the bookkeeping center of the economy and act as its social accountants. They're just accounting. They're just taking these pieces of paper that have been through a process of securitization and then putting that on an accounting ledger, and every time they open a brand new account under a name, and then they add some credit in there, that creates money right there on the spot. We're creating money every time an account is opened. That is an extension of credit creation of money in the modern credit creation system. And banks are the ones who are authorized and have this unique characteristic trait that can do that. They can do that. Okay. Going back to it, says here, this paper right here, Werner 2014A and 2014C, shows that the three theories of banking are distinguished by their differing bank accounting. By their differing bank accounting, and that the crucial difference of banks and firms without a banking license revolves around the issue of lending. Okay, in this paper right here, 2005, it was argued, quote, bank creation, let me bring this up. Let's look at this. What does it say? Bank credit creation does not channel existing money to new uses. Doesn't do that. Doesn't use existing money. It newly creates money that did not exist beforehand and channels it to some use. What makes this creative accounting possible is the other function of banks as the settlement system of all non-cash transactions in the economy. Since banks work as the accountants of record, while the rest of the economy assumes they are honest accountants, it is possible for the banks to increase the money in the accounts of some of us, those who receive a loan, by simply altering its figures. Nobody else will notice, because agents cannot distinguish between money that had actually been saved and deposited and money that had been created out of nothing by the bank. This is from page 179. That makes a lot of sense. However, surprisingly little has been written about the actual accounting details of bank operations, especially concerning their lending and how precisely it differs from the accounting of non-bank firms. It is thus corporate accounting that we must turn to in order to analyze the questions at hand in a comparative analysis of the treatment of lending by different types of corporate lenders. 2. A comparative accounting of lending. Although the implementation of banking service relies heavily on accounting, hardly any scholarly literature exists that explains in detail the accounting mechanics of bank credit creation and precisely how bank accounting differs from corporate accounting of non-bank firms. There is also virtually no scholarly literature on the question of which regulates precisely enable or which regulations precisely enable banks to create money. These issues are, however, of great interest, especially since the function of banks as the creator and allocators of the money supply is not explicitly stated in any law, any statute, regulation, ordinance, directive, or court judgment. From the absence, you know what I think? I think he hasn't read Law Merchant. It does say it in Law Merchant that's anyway. I think that's what it says. I interpret Law Merchant as that, the creation of money. Let's go back. From the absence of explicit statutory powers to create money, it can be deduced that this ability of banks is likely derived from the operational, that is, accounting conventions of regulations of banking. These either differ from those of non-banks, so that only banks are able to create money, or else non-banks have missed out on the significant opportunity money creation may afford. That's a good one. That's basically, so he's saying is that, like, you know how many people are trying to settle and discharge and settled accounts and offset it against the collateral that they are claiming is the application that was left as a security, because it was used to securitize the obligation that was created on the account. So people expect that these companies know how to do this, what banks do. It seems that it's more of a banking thing. Banks seem to know it. However, it's just an accounting thing, though. I think let's go back to it. It says he's saying it's more of an accounting thing, but banks seem to know about it. So, in order to identify the and then he's saying that that's why the opportunities, he doesn't seem to think that non-banks have been taking opportunity of this money creation process that banks have. So, in order to identify the difference in accounting treatment of the lending operations by banks, we adopt a comparative accounting analysis perspective. For this purpose, we compare the accounting of a loan extended by a non-financial corporation, NFC, such as a manufacturer extending a financial loan to a supplier, B, a non-bank financial institution, and BFI, such as a stock broker extending a margin loan to a client, and C, a bank. Table 1 shows the changes in balance sheets of a new loan of 100 million after its issuance and remittance. Wow. When the non-financial corporation, such as a manufacturer, grants a loan to another firm, the loan contract is shown as an increase in assets. The firm now has an additional claim on debtors. This is the borrower's promise to repay the loan. The lender purchases the loan contract, treated as a promissory note. See, the lender is getting something. The lender is getting the contract, which can be used in the banking world to negotiate to negotiate and then get an extension of credit. So it's really interesting. Let's go back. This is the borrower's promise to repay the loan. That's the contract. In the contract, the lender purchases the loan contract, treated as a promissory note. Meanwhile, when the firm disperses the loan and hence discharges its obligations to make the money available to the borrower, it is drawing down its cash reserves or monetary deposits with its bank. As a result, one gross asset increase is matched by an equally sized gross asset decrease, leaving net total asset unchanged. Okay. In the second case of a non-bank financial institution, such as a stockbroker engaging in margin lending, the loan contract is the claim on the borrowers that is added as an asset to the balance sheet, while the disbursement of the loan, for instance, is by transferring it to the client or the stock exchange to sell the margin trade conducted by its client, reduces the firm's monetary balance, likely held with the bank. As a result, total assets and total liabilities remain unchanged. See right here, it's very interesting. What I do? Damn it. What I do? Okay, hold on. Let's go. We almost hit the half-hour mark. Well, guys, this is interesting, right? This is very interesting. So we have reached to this page right here, which is page 3. I don't know why it says page 73 right here. Man, this is part of another page probably. This is part of another bigger paper publishing. So, but this one's only 7 pages, and you can find it under this title right here. It's a free download online. So this is interesting to study, to understand it, and to continue reading. And if you followed along all the way to right now, thank you for watching, and peace, love, and law.